Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. We have a really packed show today. We're crossing from these huge market-moving earnings reports all the way to critical macro data that could, set the cost of capital for the next year.
It really could. We've been digging through reports from CNBC, Bloomberg, Reuters, and the tension is palpable.
It is. It's this massive AI-fueled tech rally running headfirst into a delayed but absolutely critical U.S. jobs report.
It's the definition of a mixed signal market. I mean, on one hand, you have this incredible exuberance, right? It's driven by foundational tech. And for a moment, it really soothed those fears of an AI bubble.
Right.
But then on the other hand, you have this mounting evidence of a shifting labor market that the Federal Reserve just has to address. And we know they're deeply, deeply divided on what to do next.
So that's our mission in this deep dive. We're going to connect these threads. First, the NVIDIA relief rally, and just as important, the anxiety about how it's all being financed.
Then that jobs report, the massive implication it holds for the Fed's December decision.
And finally, we'll zoom out to the global stage. There are two fascinating developments: a landmark dual listing partnership and this new geopolitical race for Arctic resources.
Let's jump right into tech then, because the energy this week was just, you could feel it. After weeks of investors nervously eyeing these sky-high valuations, NVIDIA came in and didn't just meet expectations.
It bulldozed them, that's the only word for it. Looking at the reports from Yahoo Finance and Reuters, they just completely recalibrated the market. Q3 revenue was $57.01 billion.
Which was comfortably above the, $55.2 billion estimate?
Exactly. And earnings per share, $1.30, also ahead of the street. But that wasn't the headline driver, not even close.
Absolutely not. It was the forward guidance. That's what sent the stock, and really the entire chip ecosystem soaring.
What was the number?
The company forecasted Q4 sales of over $65 billion. That just blew past the average estimate of around $61–62 billion. That kind of visibility is exactly what the market was desperate for.
It quells those fears that the AI spending wave was, starting to peak.
And CEO Jensen Huang, he understood the assignment perfectly. He didn't just report numbers. He used that earnings call as a platform.
He went right at the skeptics.
Exactly. He told investors, quote, "From our vantage point, we see something very different." He was completely rejecting that AI bubble talk.
And he had the proof to back it up. I was reading that their CFO, Colette Kress, really laid out the depth of their backlog.
Oh, yeah. She confirmed they have revenue pipeline visibility for their next-gen Blackwell and Rubin chips all the way through the end of calendar year 2026.
A pipeline estimated at $500 billion.
Yeah.
That is just a staggering number.
It is. And it shows this isn't just, companies buying a few chips for a project. This is a fundamental, multi-year infrastructure build-out.
Huang even said, according to CNBC, that Blackwell chip sales are off the charts and their cloud GPUs are completely sold out.
And the global response was immediate. We saw it ripple right across the supply chain. Reuters was documenting how Asian chip stocks just exploded.
TSMC was up over 4%.
Samsung up 4.25%. SK Hynix gained over 1.5%. And then in Europe, you saw the stock's 600 tech sector climb, with key firms like ASML, the ones who make the tools for these chips, also rallying hard.
So for a moment, the consensus was clear. AI is nowhere near its peak.
But, and this is a big but, this is where the deep dive needs to go next. If you look past NVIDIA's stock price, the anxiety shifts. It shifts to the balance sheets of their biggest customers.
Right. The AI gold rush requires enormous capital expenditure, and the way the market is financing it is creating, a lot of leverage risk. Experts were flagging this to both Bloomberg and CNBC.
That's the critical nuance. The question isn't whether NVIDIA can sell chips. They can. The question is, how sustainable is the borrowing needed to buy those chips?
And we are seeing massive debt issuance from the U.S. hyperscalers.
Huge. Meta raised $30 billion. Alphabet issued $25 billion. Oracle tapped the market for $18 billion. Just like that.
All to fund this data center arms race?
Yeah.
The scale of the spending is just incredible. They've quadrupled their annual capex to almost $400 billion.
And Morgan Stanley thinks that over the next 5 years, The total needed could be $3 trillion. That leaves a potential $1.5 trillion funding gap.
Wow.
And this is where it gets really interesting. Jason Thomas over at Carlyle made this fascinating point about the changing identity of these companies.
What do you say?
He noted this subtle change of strategy. Historically, we've always celebrated big tech for being asset light, software, high margins.
Sure.
But now they're pouring 70% of their operating cash flow into concrete and steel and cooling systems. They're starting to look a lot more like manufacturing or infrastructure companies.
Wait, so if they're basically becoming utility providers with massive physical assets, these giant data centers, why are they still trading at such stratospheric valuations? That's the conflict right there.
That is the 100% conflict.
Yeah.
His point raises this huge valuation question, especially for bond investors. These firms trade at price-to-book ratios of, 11 times on average? If they start acting like capital-intensive infrastructure firms, which trade at way lower multiples, that whole valuation model just breaks down.
So if the bubble isn't in NVIDIA stock, is it migrating to the high-yield bond market that's funding all this?
That's the real source of the jitters that analysts at Man Group were pointing to, and that's before you even get to the physical supply chain stress.
Okay, let's talk about components. The demand for specialized AI hardware, specifically high bandwidth memory, or HBM, is creating shortages everywhere else.
It's a really complex bottleneck. HBM is this stacked memory that gives you the incredible speed you need for AI training. It's expensive, but it commands huge margins, so suppliers like Samsung are, as Yahoo Finance reported, aggressively prioritizing it.
And the consequence of that is it's starving the broader market for standard DRAM.
Exactly, the boring memory that goes into everything else, your PC, enterprise servers, even medical equipment.
So because they have to shift production from DRAM to HBM, reports are suggesting that Samsung has jacked up prices on some of these standard memory chips by as much as 60%.
60%. So this isn't just a corporate battle between giants. This is a cost increase that's felt across the entire electronics ecosystem, and it's all driven by this AI arms race.
That sets the stage perfectly for our next segment, because all that corporate debt we just discussed is incredibly sensitive to interest rates.
A $25 billion bond is manageable when rates are low. It's crippling if they spike.
Which is why we have to pivot to macro. Because today's jobs data is going to directly impact whether refinancing all that debt gets cheaper or a whole lot more expensive.
Exactly. Today is a massive data day. As Bloomberg and Yahoo Finance have been emphasizing, we finally get the long-delayed September U.S. non-farm payrolls report.
And because of the government shutdown delay, this is it. This is the last major official snapshot of the labor market before the Fed's final meeting of the year in December. It's a make-or-break moment.
It really is. Economists are projecting pretty modest job gains, maybe around 51,000, and the unemployment rate is expected to hold steady at 4.3%.
But the market isn't going to react to the headline number so much as what it means for the Fed's internal conflict.
And we know from the October FOMC meeting minutes that the Fed is highly conflicted. Yahoo Finance detailed this. The minutes revealed strongly differing views on a December rate cut.
How big was that divide?
It was pretty substantial. You had some officials who felt a rate cut might be appropriate soon, but then many others thought it was crucial to hold rates steady, maybe even through all of 2025.
What were they afraid of?
Their biggest fear, according to the minutes, was misinterpreting their own commitment to the 2% inflation target. If they signal a cut too early, inflation expectations could just shoot right back up.
So if you're an investor watching the release at 8:30 a.m. Eastern, you have to look past the job count and zero in on the unemployment rate.
That's the signal. As CNBC highlighted, even a tiny uptick, say 0.1% from 4.3 to 4.4%, could be the trigger.
And that small move would signal enough economic softening to bring rate cut bets right back onto the table.
Right. It would suggest the economy needs a break. But if it holds steady or dips, the Fed has almost no incentive to change its hawkish stance.
And this data is landing right as the whole labor market narrative is changing. For months, we've had this no hire, no fire idea.
Right, where companies were just hoarding talent after the pandemic, but that seems to be unraveling. Economists cited by Yahoo Finance are now talking about a shift to a no-hire, start-to-fire market.
And there's evidence for that outside the official numbers. October was the worst month for planned job cuts since 2003. And these WARN notices, the mass layoff warnings, they've spiked.
They've spiked in 21 states. And that's significant because these aren't just rumors. These are legally required 60-day warnings. A surge in those is a major leading indicator, and reports say they're at some of the highest levels since 2006.
And we're talking about huge rate-sensitive companies like Amazon, Verizon, Target.
It connects everything. A weak jobs report means the cost of capital likely drops, which eases the burden on those leveraged hyperscalers. A strong report, the Fed stays tight, and those billions in new infrastructure debt get a lot more expensive.
Okay, let's widen the lens now and look at how global markets are positioning themselves, starting with a really bold move out of Singapore.
This is a fascinating story from CNBC. It's all about cross-border ambition. Singapore's SGX and the Nasdaq announced what they're calling a landmark partnership.
Their goal is to create a new global listing board for companies with a market cap over about $1.5 billion US.
And the key is simplifying dual listings. Historically, it's a regulatory nightmare. This deal streamlines the whole thing. A single set of documents, a simplified review process, all set to go by mid-2026.
It's a very deliberate attempt by Singapore to grab market share by just cutting the red tape.
Exactly. The SGX CEO, Loh Boon Chye, said the main beneficiary is the investor. This new bridge offers price discovery almost round the clock.
Which means 24-hour liquidity and risk management. Plus, you can choose to trade in US dollars or Singapore dollars.
And the Monetary Authority of Singapore even threw in a $30 million value unlock package just to sweeten the deal.
It's a clear play for capital. But if we shift from capital to resources, there's a parallel scramble happening in the Arctic. CNBC is calling it the cold gold rush.
And this brings us right back to the AI story, believe it or not. The focus is on Greenland, where melting ice is making rare earths and base metals much more accessible.
And why is this so critical? It comes down to two specific metals, gallium and germanium.
Right. We talked about the HBM memory bottleneck. Well, gallium and germanium are critical ingredients for semiconductors and also for advanced military tech.
And the primary global producer is China, which has shown it's more than willing to use export controls as a geopolitical weapon.
So for the US and Europe, finding alternative, stable sources, like in Greenland, is now being seen as an urgent national security priority.
And companies are already moving in. Amarok, Critical Metals, they're developing projects there, and they've found commercial levels of both metals.
But here's the reality check that always comes with these gold rush stories, turning a serious profit in the Arctic with the logistics and the climate. It's a 15 to 20-year commitment. This is a very long-term resource play.
But all those trillions flowing into AI data centers depend on the global supply chains for these exact materials. Geopolitical control here directly impacts the cost of that whole AI boom.
It's all connected.
Finally, let's turn to a pretty significant and potentially troubling geopolitical story developing around Ukraine.
Yeah, reports have surfaced, and the details are still murky, but they suggest the U.S. and Russia might have developed a secret 28-point peace plan.
And the allegations, which CNBC and others have reported on, citing unnamed sources, are that the plan involves major concessions to Moscow.
Things like Ukraine ceding territory in the Donbas region and drastically cutting its armed forces, maybe by as much as 50%.
We know that a senior U.S. military delegation is in Kyiv right now on a fact-finding mission.
But the crucial detail here is that a Ukrainian official has confirmed that Kyiv was not involved in preparing any of these proposals.
And the official denials are a bit careful. The Kremlin denied any immediate innovations, and the U.S. Secretary of State only went so far as to confirm that new proposals are in the works and that any peace would require difficult but necessary concessions.
It puts Ukraine in an incredibly vulnerable position. Their strength relies on Western aid, and if their allies are discussing their future without them, that reliance becomes a huge liability.
So as we wrap this up, what's the big picture here? You have to see this core tension. The AI boom is real. It's undeniable. NVIDIA's execution is phenomenal.
But the colossal debt financing it requires injects a huge amount of systemic leverage risk right into the foundation of that growth.
And that foundation is acutely sensitive to the jobs report we get today. The outcome dictates whether the Fed keeps rates high, making that infrastructure brutally expensive, or if they ease up and provide some relief.
And looking further out, this idea of sovereign AI, which NVIDIA and others are talking about, it connects the entire narrative.
What do you mean by that?
When you hear about these massive government-backed data centers being built by countries like Saudi Arabia, they become huge strategic customers for NVIDIA. It means AI infrastructure is now being treated as a national security asset. not just a corporate spending item.
The sovereign AI concept links the debt, the resource grab in the Arctic, and the geopolitical pressures. The future of tech power is about who controls the compute. And that raises our final provocative thought for you. If the foundation of future global power is built on these complex, government-backed data centers, which need enormous debt, depend on politically volatile mineral supply chains, and are treated like essential national hardware, does this create new, completely unexpected fault lines in international finance and tech, beyond the usual US-China dynamic? We are watching the infrastructure of future geopolitics being poured in concrete right now.
The race isn't just about software anymore. It's about who controls the hardware and, just as important, the money to build it.
We'll see you all tomorrow morning with new headlines from major financial magazines.